Every day when the market closes, Milk pulls data from the option analyzer using the fractal chart 7 wave 60 minute, which Milky was just displaying. We don't just do this to know where price can seek, but we do it to understand the structure behind it. We're able to follow a specific structured plan based on probability, execution, and discipline. At the center of this approach is the yellow box, the expected range where price stays 80 to 90% of the time. This is nowhere near random. This is where liquidity resides, where traders position themselves, and where price naturally gravitates. The yellow box is the foundation of price action, the core balance zone where trading activity is most concentrated. It is where price consolidates, finds support and resistance, and reverts before its next move.
The edges of the yellow box serve two crucial roles. Breakpoints. If price breaks out, it can signal continuation into the next range. But if price struggles to break, the edge may hold and force price back into balance. This can signal a range-bound day. By understanding these dynamics, traders can anticipate the next probable cycle of the market. One of the most powerful concepts in this model is the yellow box break, when price moves beyond the yellow box boundaries and starts seeking its next level. A break above the yellow box signals we have a high probability of upside to the top of our average range resistance. Then, using the model and other confluences, we can reevaluate for a reversion or a continuation. Similar to a break above, a break below the yellow box shifts focus to the bottom of average range support. We can increase our win rate by using candle closes to know when the market sees fair value, higher or lower. Getting a 5-minute or even a 1-minute close above the yellow box drastically increases the win rate. When these confirmations aren't present, it can often be a false breakout leading to a rejection back into the yellow box.
And we could also use the E and S vectors for additional confirmation. Often the vectors fall inside the yellow box. These vectors work as support or resistance. If price is above or below both vectors, it gives us bias on which the closer the vectors are to each other, the stronger they are when we are above or below it. Once price moves into average range, it enters a critical decision zone. Here we determine whether price is gaining momentum for continuation or will reject back to balance. Rejection from the average range provides some of the best risk to reward setups, and here's why. Defined risk. If price rejects, we can set stops just past the rejection point, keeping losses very minimal. High reward potential. Since price naturally gravitates back towards the yellow box, the reward outweighs the risk. Early confirmation. If price fails to hold in the average range, it's an early indicator of momentum weakening. These rejections are very powerful as they allow traders to execute high probability trades with well-defined parameters. But if price breaks back through the average range, we can start to look for other confluences, such as our IV and spread monster levels. Instead, we should focus to confluence factors, the broader market conditions that confirm the next move. We then have our max range and max trend, which help us determine risk-off points for outlier moves such as days with strong sentiment or news events.
By applying this framework, we transition from reactive trading to strategic trading. We are not only reacting to price, we have a clear guideline and outlook for most of the outcomes of the market before they even happen. This is why structure matters. By following this model, we eliminate emotional trading and trade with confidence.
The yellow box defines where price wants to stay. Yellow box breaks provide potential trade opportunities. Average range rejections give great risk to reward setups. Average range breaks give a chance for continuation pending other confluences and volatility. Confluence factors determine whether price expands or reverts above the yellow box. And this is what separates successful traders from struggling ones. We don't trade on impulse or emotion. We trade with structure. This is Wave 760 Minute Option Analyzer, a system built on probability, structure, and execution.
Thank you to Milk, Moose, and Russell for sharing the hard work they have done to create a model like this for us. They have gone through trial and error in developing such an edge in the market.
Thank you guys.